You're probably not ready for what happens when central banks lose control of inflation. Because it's not just about higher prices, it's about a system-wide shock that can collapse markets, destroy savings, and rewrite the rules of the economy as we know it. We've been living through a period where inflation was considered a solved problem. For decades, central banks kept it in check with a mix of interest rate policy and public confidence. But what happens when those tools stop working? What if inflation no longer responds to rate hikes, no longer respects central bank guidance, and starts behaving like a runaway train? In the 1970s, inflation surged past 13% in the US, wiping out the real value of wages and savings. At that time, the Federal Reserve under Paul Volcker raised interest rates to nearly 20%. It caused a deep recession, but it worked. Inflation was crushed, and central banks earned credibility as the ultimate guardians of price stability. But now, imagine a world where inflation surges again. But this time, central banks can't stop it. Not because they don't want to, but because doing so would crash the financial system. We're in a much more fragile environment today. Massive public debt, speculative asset bubbles, and a public addicted to cheap credit. And that's the terrifying scenario we're going to unpack in this video. If you stay until the end, you'll understand the ripple effects of a central bank losing control. And more importantly, how to protect yourself if this becomes our reality. Let's start with the biggest lie the public believes: that central banks can always fix things by printing more money. But printing money doesn't create value, it dilutes it. It only works as long as people believe in the value of the currency. The moment that belief cracks, the system can unravel shockingly fast. And here's what makes today different. Inflation isn't just caused by temporary shocks. It's becoming structural. Global supply chains are shifting from efficiency to resilience. Governments are spending aggressively to reindustrialize, fund climate transitions, and support aging populations. These policies may be necessary, but they're inflationary by nature. Worse, we're seeing the early signs of a self-reinforcing inflation cycle. Companies raise prices not because costs go up, but because they expect inflation. Workers demand higher wages, not just to keep up, but because they anticipate further erosion in purchasing power. This feedback loop is deadly for economic stability. Central banks try to intervene by raising interest rates, but they face a painful dilemma. If they tighten too fast, they trigger recessions, crash housing markets, and explode government borrowing costs. If they don't act, inflation becomes entrenched and trust in money evaporates. So instead of leading the economy, the central bank becomes a spectator. Its policies lag behind inflation. It reacts instead of shaping expectations. And once that happens, investors start to panic. They dump government bonds, pushing yields through the roof. Currencies weaken. Import prices explode. Suddenly, even the basic assumption that your cash will hold value next month is under question. And that's when markets really start to break. Stock valuations collapse, not just because of recession fears, but because future earnings become impossible to predict. Discount rates are all over the place. The risk-free rate isn't risk-free anymore. Think this is a far-off nightmare? It's already happening in some countries. Argentina, Turkey, Lebanon. We've seen what it looks like when central banks lose control. Capital flight, social unrest, political instability. But what happens if this spreads to developed economies? What if it's not just emerging markets anymore? What if it's the US, the Eurozone, or Japan? That's where we're heading next. Let's explore what happens when inflation becomes immune to the old playbook. In theory, central banks control inflation through two primary tools: interest rates and liquidity. Raise rates to slow down borrowing and spending. Reduce liquidity to pull money out of the system. Simple enough on paper. But today, those tools are becoming blunt. Because we're no longer dealing with a regular inflation cycle triggered by excess demand or a supply shock. We're dealing with inflation rooted in something much deeper: structural changes in the global economy. Take energy, for example. For decades, fossil fuels powered cheap growth. Now, with the transition to renewables, energy systems are becoming more expensive, more complex, and more fragile. Green energy is vital for the future, but in the short term, it adds cost, not savings. Then there's the demographic time bomb. Populations are aging across the developed world. That means fewer workers, more retirees, and skyrocketing healthcare and pension costs. To fund those obligations, governments borrow more, fueling inflation even further. Deglobalization is another culprit. The golden age of globalization kept prices low thanks to cheap labor and just-in-time logistics. But that system is breaking down. Countries are reshoring factories, building redundancies, and prioritizing national security over cost efficiency. All of this is inherently inflationary, and it's happening at the same time as political pressures are rising. Governments are demanding that central banks stay supportive, that they don't raise rates too aggressively or threaten growth. So even if inflation starts climbing, the central bank may hesitate to act. Now imagine inflation hitting 6%, then 8%, then 10%. But the central bank only raises rates by 1%, maybe 2%, to avoid crashing asset prices. That's when things get dangerous. Because markets can tell the central bank is bluffing. Investors start looking for alternatives. They flee government bonds. They dump currencies. Gold, commodities, real estate, anything real suddenly becomes more attractive than cash or paper assets. And then comes the political backlash. People's savings are eroded. Middle-class households can't keep up. Inflation becomes the dominant issue in every election. Populism rises. Leaders blame speculators, foreign interference, or corporate greed. Central banks are forced to become political tools instead of independent institutions. It's already happened before. In Weimar Germany, in Venezuela, in Zimbabwe. Once inflation psychology takes over, once people expect prices to rise, it becomes a self-fulfilling prophecy. But there's something even more alarming. What happens to the entire financial system when the risk-free asset, government debt, is no longer safe? If inflation keeps rising and bond yields don't compensate for it, investors won't just suffer losses, they'll abandon bonds altogether. That's catastrophic for pensions, insurance companies, and banks, which rely on government bonds as core assets. Suddenly, the system faces a solvency crisis. Governments can't roll over their debt without printing money. That printing drives inflation even higher. And round we go in a vicious cycle that ends with a crash. This isn't about predicting a specific timeline or saying hyperinflation is around the corner. It's about understanding that the trust-based system we rely on is vulnerable. And once the illusion of control breaks, restoring it is extremely hard, sometimes impossible. Coming up, I'll show you what the smart money is doing to prepare. Because in a world where central banks lose control, survival belongs to those who adapt before the chaos hits. So what do you actually do if central banks lose control of inflation? Because once that trust is gone, once the public, the markets, and global investors stop believing that central banks can stabilize prices, it's too late to start preparing. By then, the damage is already spreading like wildfire. The first thing to understand is that traditional portfolios break down. The 60-40 portfolio, which relies on a mix of stocks and bonds, suffers on both ends. Stocks fall because higher inflation crushes real earnings and discount rates rise. Bonds fall because they pay out fixed income in a currency that's losing purchasing power every month. Even cash isn't safe. Savers who thought they were playing it safe get punished the most. Because while their money sits in a bank, its value is being silently eroded, month after month, year after year. That's why when inflation becomes untethered, the smart money flows into real assets. Not speculation, not crypto hype. I'm talking about tangible, productive, and scarce assets that can hold or grow in value even as the currency melts. Real estate is one of the most powerful inflation hedges if it's carefully selected. Not all property is equal. Look for assets with pricing power, residential properties in supply-constrained cities, agricultural land, or strategic industrial zones. These are places where landlords can raise rents in line with inflation and where demand won't disappear overnight. Commodities also come into play. Gold is the classic safe haven, and it tends to outperform during periods of uncertainty and currency debasement. But broader commodities like energy, metals, and agricultural inputs become even more valuable when inflation is driven by structural shortages. Owning them through ETFs, producers, or even direct exposure is how institutions and billionaires protect purchasing power. Another shift will likely see us toward productive equities with real pricing power. Forget the high-growth, zero-profit tech stocks. In an inflationary regime, markets reward companies that produce necessities, energy, food, raw materials, and can raise prices without losing customers. Think of it this way. In a high-inflation environment, your best friends are scarcity, utility, and productivity. Everything else gets re-rated, often violently. And don't overlook geographic diversification. If inflation gets out of control in the US or Europe, having exposure to economies with stronger fiscal discipline or resource wealth could be a lifesaver. This could mean investing in global ETFs, holding foreign currency accounts, or owning international real assets. But the most overlooked asset during inflation isn't a stock, or a property, or a metal. It's flexibility. People who own their own time, their own skills, their own businesses, they adapt faster. Because when the system breaks, the rules change. And those who rely entirely on traditional institutions, governments, pensions, fixed salaries, suffer the most. That's why more and more investors are turning toward entrepreneurial ventures and automated income streams. Owning a cash-flowing business, even a digital one, gives you pricing power. You're not just reacting to inflation, you're adjusting your prices, your costs, your margins. And finally, there's mindset. Because the greatest threat during a period of runaway inflation isn't just financial, it's psychological. Fear, panic, and denial can destroy wealth faster than bad markets. The people who thrive are those who stay informed, who keep adapting, and who understand that wealth isn't about dollars, it's about value. To wrap this up, if central banks lose control of inflation, the winners will be those who saw the writing on the wall and acted early. Those who moved their assets, shifted their habits, and stopped relying on a broken system to protect them. So here's what you can do right now. Audit your exposure to inflation risk. Reduce dependence on fixed income assets. Increase your allocation to real assets and cash-flowing businesses. And above all, stay mentally prepared for a world where stability is no longer the baseline. Because if you wait for headlines to confirm what you already suspect, it's already too late. So we've covered what happens when inflation spirals, why central banks may no longer be able to stop it, and how you can adapt before the system breaks. If you found this video valuable, hit like and subscribe. It helps more than you think. Check out our previous episode on how to build a portfolio for inflation-resistant wealth. And let me know in the comments, do you think central banks are still in control? The sooner you prepare, the sooner you'll protect your wealth. Don't wait for the storm to hit. Start building your shelter today.